Hey guys, I'm Danny. Welcome to Capital Cosm. I have a question for you. What determines value? In a world where everyone knows the price of everything and no one knows the value of anything, how do we determine if something is over or undervalued? In today's video, we're going to look at ratios and the importance of ratios in determining an asset's class's valuations. We're going to look at stocks and real estate. And we're going to use this website, longtermtrends.net. It has a host of different charts looking at stocks' valuations relative to gold, oil, real estate, and a bunch of other cool metrics. We're going to chalk up each overvaluation metric in one category versus the other. And at the end of the day, we're going to figure out whether stocks and real estate are overvalued. And why this is important is that we're considering multiple charts. We're considering multiple angles to this. We're not using one data point to make a decision as to whether stocks or real estate or any asset is over or undervalued. We're going to look at a number of different charts, and we're going to see where things kind of land out. So the reason why ratios are important, ratios tell you the price of something relative to something else. It answers the compared to what question. And the reason why that's so important is because the money supply is ever expanding. It's inflationary. You could make a pretty good living off of $20,000 a year 50 years ago. But you can't today. Does that mean the value of everything has gone up? Does that mean my mouse is more valuable today than it was 10 years ago? I mean, it's a pretty good mouse, but does that mean the shirt on my back is more valuable today than it was 100 years ago? No. It's only the fact that we've expanded the money supply. You could take a single gold coin and buy a finely tailored suit today. Now, you could hop on a time machine, go back 2,000 years into the past, and take that very same gold coin and buy a nice toga. What does that mean? It means the value of gold has maintained itself over time because you can't create more gold at will like you can with currency units like USDs, like any other currency. So this is why ratios are so important, and this is why we're going to look at ratios in this video. So let's go ahead and get started. But standard disclaimer, this is not financial advice. I am not a financial advisor. Please do your own due diligence. Okay, so first on our list is the S&P 500 PE ratio. So this ratio is a price to earnings ratio dividing the company's stock price by its earnings per share. And it's one of the most fundamental ratios to look at in determining over or under valuation in a stock or in anything or in any asset. So the S&P 500 price to earnings ratio, this is where we're sitting at today. At about 18, a ratio of 18. We've come off the high here quite a bit. This was, I think it was like 48 or something. The mouse isn't really toggling to it. But the dashed line here tells us our mean. We're still a little bit away from the mean, but not too far. I'm actually going to say that this is not overvalued. So I'm going to chalk this up on the not overvalued category. So stocks, they got 1 point on the not overvalued category. So if we were purely looking at this chart, you could make an argument that we were at fair value. Let's take a look at another cool chart. This is the Buffett indicator, made famous by Warren Buffett himself. And this looks at market cap to GDP. So market cap to GDP over time. So this goes all the way back to the 1970s. And we basically look at the mean as it stretches out, sitting at about, I want to say, maybe around 90. We're at 150%, just about 153% to be exact. So we still have a ways to go to revert back to mean. Now, would you say that this is an indication that we're still overvalued? Well, I would say so. I mean, we're still at the same levels that we were in 2000. And, starting from 2018, this is about the same time that the Fed started raising rates before the pandemic. So I'm actually gonna chalk this on the overvalued category. So it's neck and neck. It's 1-1 for the stock market. Another relevant chart to look at, stocks to real estate ratio. Here we've got the S&P 500 divided by the Case-Shiller Home Price Index, and this tells us how stocks are priced relative to a house. It says here, so essentially it's how many shares of the S&P does it take to buy the average house, and I would say we're still a little overvalued here, compared to this long-term time horizon. We're below the dot-com bubble. We've corrected quite a bit, but I think there's still a ways to go. So I'm going to chalk this as overvalued for real estate. And I'm going to chalk this as not overvalued. You can call it fair valued, whatever, for real estate. Sorry. Overvalued for stocks, not overvalued for real estate. Dow to gold. So this takes into account the price of gold. So how many ounces of gold do you need to buy a share in the Dow? Let's take a look. Again, the Dow is another one of those big market indices that we look at. So we're not as bad as we were during the dot-com bubble. We're about on the same level as in early 1970s. It's called the Nixon shock, when Nixon took us off the gold standard. But I wouldn't say that we're at fair value here. So I wouldn't say that we're overvalued. Well, we've come up quite a bit, actually, since the 2010s. If you look at where we were versus the 1980s, we've gapped up quite a bit. So I'm going to say that this is an overvaluation for stocks. So right now we're at 3-1 for making a case towards stocks being overvalued. Let's look at what else do we have. Let's look at real estate to gold. So the real estate to gold ratio tells us how many ounces of gold we need to buy the average house, the average single family house in the United States. And we're sitting pretty low, actually. Real estate is very undervalued relative to gold. So I'm going to say that real estate to gold, undervalued, or not overvalued at the very least. Copper to gold. So we've got two commodities here. So what does this have to do with either stocks or real estate? Well, copper got its name as Dr. Copper for a reason. The price of copper typically tracks the health of the economy. So an overperformance of copper relative to gold indicates a healthier economy. And let's take a look here. As you can see in the prior to the housing crash in 2006, we hit our peak here in copper to gold. But we're actually not copper to gold level. I'd say I'm going to say this is a tough one to call actually for stocks. I'm going to say we're not overvalued. So it's 3-2 on the stocks side of things. Oil to gold. So this looks at how many ounces of gold does it take to buy a barrel of oil? And the higher this ratio is, a better indication of the health of the economy. That means we're using more gold, we're producing more things, yada, yada, yada. So we're sitting at a pretty good, we're sitting at about 0.04. So we're nowhere near the highs of the mid to late 2000s. Let's kind of expand this out, get a better view. Yeah, I'm going to say that this is indicative of, I don't think we're undervalued. I don't think we're overvalued here for stocks. So I'm going to say not overvalued. Oh, I don't have it here. Let me just quickly copy paste it. Cool. So we're about neck and neck on the stock side of things. Let's see what else. Cool. Stocks to commodities ratio. Let's pull that up. So stocks to commodities ratio measures the S&P relative to the commodity market index, essentially the producer price index. Sort of like how we as consumers, we have our CPI, our consumer price index, to track the price of our consumption on everyday goods. Producers have that same index for them, essentially wholesale prices, in this case the commodity market index. And yeah, I mean, we are overvalued. Overvalued in stocks relative to commodities. So I'm going to chalk that up here. And let's see, what else? What else do we have? Okay, so let's wrap it up for real estate. On the real estate side, home price to income ratio. How much? So this tracks the average price of a house compared to the median annual household income in the United States, and it takes houses are. Let me phrase this a different way. Incomes haven't tracked the increase in housing prices for the last 3 or 4 years here at least. Actually, let's go back further. Since 2012, really. House prices have increased much more, much faster than wages have increased, essentially. And I would say this is obviously overvalued. So real estate is going to have its first overvalued data point. And then finally, we have the real home price in the United States. So this is essentially a ratio looking at the nominal home price in the United States and then divided by the consumer price index. So we're controlling for any sort of inflation in the market, in the housing market. And yeah, we're overvalued, clearly. Let's actually pull it back a bit, get a bigger view. Yeah, definitely overvalued. So let's take score here. Stocks, we have 4 data points in the overvalued category versus 3 in the not overvalued. So stocks, I'm going to say are a bit overvalued. There's still some headway down there's some downside potential. Real estate, it's a bit tougher to call. I have it at 2 to 2. The home price to income ratio shows that we're overvalued, and the real home price, it shows us that we're overvalued as well when controlling for inflation. Wages haven't kept up with home prices, as well as home prices have just risen really fast over the last 10 years or so. But you can also make the case that it's not overvalued by looking at stocks versus real estate. By also looking at real estate to gold. You can buy more real estate. You can buy more real estate today with an ounce of gold than you could in most other periods of time in the past. So, real estate, I'm going to say that we're in fair territory. Stocks, I'm going to say, are a little overvalued, just on the basis of our little, our little analysis here. So, let me know what you guys think. Are there any charts that you would consider as well in making a determination between over and undervaluation for these two different asset classes? Let me know in the comments below. And if you like these kind of videos, please hit the like button, and of course subscribe to the channel. That's always helpful for me as well, in delivering more content like this for you. And yeah, until next time, guys.